There's a critical lesson in the playbook of the smart money that defines the difference between the wealthy and the liquidated. It is a rule that must be seared into the mind of every serious investor. Be terrified when positive news breaks at the exact moment the market is sitting at an all-time high. When charts are peaking and suddenly the airwaves are flooded with euphoric predictions, claims that prices are going to the moon, that nothing can stop the rally, that is the definitive signal to exit. The market consensus may understand the long-term destination of the price, but the immediate path is never a straight line. When the market stands at the summit, barely catching its breath, and the media begins screaming, "Buy, buy, buy," one must ask the uncomfortable question, why now? Why, when consolidation hasn't even occurred, is the narrative insisting it is a sure thing? The answer is simple and brutal. The big players, the institutional whales and market makers, leak this positivity for a singular strategic reason: liquidity. To sell billions of dollars worth of assets at a peak, they require a counterparty. They need a fresh wave of buyers to step in so they can offload their positions without crashing the price immediately. They require the retail investor, the one who missed the first move, or the greedy speculator chasing momentum to provide the cash they are extracting. By creating a buzz, they make the price wobble and dance at the top, luring capital in with the promise of easy money. And then, inevitably, the trap snaps shut. The price corrects. The institutional money is exited with massive profits, while the latecomers are left holding the bag, confused by the sudden reversal. This phenomenon is often sanitized as profit-taking, but structurally it functions as a wealth transfer. Only after the losses pile up does the realization dawn. The news wasn't a forecast. It was a marketing campaign for an exit strategy. This is why news must be viewed not just as information, but as a contrarian indicator. It reveals where the sentiment lies, not necessarily where the price is headed. This concept is currently playing out in real time within the gold markets. And now, with prices sitting near this local bottom, waiting for a catalyst, the geopolitical landscape has delivered a seismic shift. Donald Trump has stepped onto the stage to effectively declare war on Venezuela. Today, January 3rd, 2026, marks the beginning of a new conflict cycle. The official headlines claim the mission is to fight drug cartels, to liberate the Venezuelan people, or to retaliate for the arrest of 5 Americans by the Venezuelan regime. The rhetoric is noble and heroic, framed around national honor and the protection of citizens. However, sophisticated analysis requires looking beyond the rhetoric. In geopolitics, there are no heroes, only interests. This decision was not made on a whim regarding drug trafficking or dictatorship, both of which have existed for decades. The decision was made by looking at the map and the reserves. Venezuela sits on the largest proven oil reserves in the world. This is not merely a police action. It is a resource acquisition strategy. It is a calculated move to seize control of the global energy supply at a time when energy is transitioning into the ultimate geopolitical weapon. Just 24 hours prior to this announcement, the other side of the world was already destabilizing. Iran is in chaos, with massive demonstrations rocking the streets of Tehran and the rial collapsing in freefall. The economy is imploding. Sensing blood in the water, the U.S. administration issued a warning to the Iranian regime: do not touch the protesters. This is a veiled signal that military intervention is on the table in the Middle East as well. Connecting these dots reveals a terrifying picture. Iran controls the Strait of Hormuz, the choke point through which 20% to 30% of the world's oil flows. Venezuela holds the world's largest oil reserves. This is not a coincidence. It is a coordinated strategy to encircle the energy market. Just as China has spent the last decade locking down the supply of rare earth metals and silver, the United States is now making its definitive move to lock down the oil. Part 2, this is the great game of the 21st century. A game of strangulation and resource denial. The United States is effectively signaling to the world that it intends to control the tap. Washington is pressuring India to stop buying Russian oil, pressuring Europe to diversify away from Eastern energy, and building a blockade, not just with ships, but with influence, sanctions, and now direct military intervention. The objective is to hold the master key to global energy, ensuring that in any negotiation with China, the U.S. holds a loaded gun. The official justifications, drug cartels, political prisoners, are secondary. These issues are tragic, but historically, they rarely serve as the casus belli for a full-scale invasion unless strategic interests are aligned. The timing is the tell. The world is in a phase where the gray zone is disappearing. Nations are being forced to choose, align with the U.S. or align with China. To win this confrontation, leverage is required, and oil remains the ultimate leverage. Bringing this back to the financial markets, specifically gold, the implications are profound. While war is a humanitarian disaster, historically, it acts as rocket fuel for precious metals. There is a cynical but accurate axiom in the markets: buy when there is blood in the streets. This reflects the cold reality of how capital protects itself. When war breaks out, the first casualty is certainty. No one knows the duration, the scope, or the potential for escalation. Will Venezuela fight back? Will Russia intervene? Will Iran close the Strait of Hormuz? This uncertainty creates visceral fear, and fear is the primary driver of gold. Investors flee risky assets like equities and pour into the safety of gold, the ultimate hedge against chaos. There's a direct, undeniable correlation that must be analyzed. The link between gold and oil. These two commodities often move in tandem. When oil prices spike, gold almost always follows. This correlation was vividly demonstrated in 2007 and 2008, when oil prices skyrocketed to $147 a barrel, and gold rallied alongside it. It was seen again during the COVID crisis. When oil went negative, a moment of total economic paralysis, it signaled a deflationary collapse. But as soon as the Federal Reserve activated the money printer and the economy restarted, oil surged and gold surged with it, hitting new all-time highs. Why does this happen? Because oil is the lifeblood of the global economy. When oil becomes expensive, everything becomes expensive. Transportation costs rise, manufacturing costs rise, food prices rise. This creates inflation. Gold is the historic cure for inflation. Therefore, when the market sees oil rising, it anticipates inflation and buys gold as protection. Consider the current situation. Oil has been beaten down, trading in a bear market below $60 a barrel. It is cheap and unloved. Suddenly, the world's largest superpower invades the country with the world's largest reserves, while simultaneously threatening the country that controls the world's busiest oil transit route. It is highly improbable that oil will remain at $60. If a single tanker is sunk in the Strait of Hormuz, or if Venezuelan production is taken offline by sabotage, oil could spike to $100 or more overnight. If oil spikes, gold will inevitably fly. This brings the focus back to the core concept, the timing of news. Just as one must be wary of good news at the top, one must pay close attention to bad news, or massive geopolitical shocks, when the price is near bottom. Gold was sitting at $4,274, languishing and consolidating close to the $4,250 floor. Then, boom, war. This is the catalyst the market was waiting for. The smart money likely anticipated this possibility, accumulating positions while the general public was bored. Now, the news cycle is catching up to the price action. The technical setup is fascinating. The market recently hit a major high of $4,550. Following that peak, it corrected. This correction was technically necessary because of unfinished business below. Back in October, the market hit a high of $4,980, which acted as a resistance level. The price smashed through it on the way to $4,550 without looking back. In technical analysis, markets dislike leaving gaps or untested levels. The breakout happened too fast. Therefore, the price had to return to kiss that breakout level, turning previous resistance into support. The market needed to prove that $4,708 is no longer a ceiling, but a floor. The drop to $4,274 accomplished this. It tested the zone, flushed out the weak hands, and confirmed that buyers remain present. The market is now sitting in a perfect technical structure. A higher low established, the $4,250 fortress defended, and a massive fundamental reason, global war, provided to push prices higher. The stars are aligning for the next leg of the bull market. This dynamic is not limited to gold. It affects the entire financial ecosystem. Silver will follow gold, often with even more explosive volatility. If gold moves 1%, silver typically moves 2% or 3%. The industrial demand for silver in wartime, for electronics, solar panels, and guidance systems, adds another layer of bullish pressure. Looking deeper at the geopolitical adversary, China is undoubtedly watching the Venezuelan intervention closely. Beijing has invested billions in Venezuela, loaning money to the Maduro regime in exchange for oil. They will not be pleased with the U.S. stepping into their sphere of influence. This increases the tension between Washington and Beijing, moving the world closer to a bifurcated reality, a Western bloc led by the U.S. and an Eastern bloc led by China. In a world split in two, the dollar becomes a weapon, not just a currency. When the dollar is weaponized, nations look for a neutral reserve asset. That asset is gold. Central banks are already buying gold at a record pace. This war will only accelerate that trend. Countries in the global south, watching the U.S. seize Venezuelan assets, are not thinking their money is safe in New York. They are realizing they need to store wealth in assets the U.S. cannot freeze. This is the hidden narrative. While the media focuses on drug cartels and democracy, the market focuses on liquidity, energy control, and safe haven assets. The invasion of Venezuela acts as a desperate move to secure tangible assets in a world where paper money is losing credibility. The U.S. has a significant debt problem, facing a $10 trillion refinancing wall in 2026. To keep the economy afloat, the U.S. needs to manage oil prices, but it also needs inflation to burn away the real value of its debt. War is inflationary. It is the perfect storm. Amidst all this, the gold chart paints a clear picture. Consolidation is complete. Support has been tested. The narrative is set. The $4,150 high was not the end. It was the first base camp. The smart money is already positioned. They bought the dip when gold was boring. They bought when the price drifted down to $4,274 and the public was asleep. Now, as the military operation commences, the retail public will wake up. They will see the headlines, feel the fear, and start buying. This influx of capital will provide them momentum to break through the recent highs. However, the warning remains. When the price reaches $4,800 or $5,000, and the news turns overwhelmingly positive again, when pundits claim gold is the only asset to own, that peace is restored, or that the economy is booming, that is when caution is required. That is when the cycle repeats. For now, the trend is clear. The fundamentals, war, debt, de-dollarization, and energy scarcity, are all pointing in one direction. The technicals, a successful retest of support and a higher low, confirm it. This is a time for steady hands, not panic over daily fluctuations. The script has been written. The U.S. is making its play for energy dominance. China is making its play for metal dominance. And gold sits in the middle, the ultimate arbiter of value. As these events unfold in Venezuela and Iran, the human tragedy of war cannot be ignored. But as market participants, one must see the world as it is, not as one wishes it to be. The priority is to protect wealth from the turbulence that is coming. In conclusion, one must not be distracted by the moral arguments presented in the news. Focus on the flows of capital. Focus on the barrels of oil. Focus on the ounces of gold. The United States is tightening its grip on the Western Hemisphere's energy supply because it recognizes that in the coming confrontation with China, energy is the only resource that rivals technology in importance. The world is entering a period of extreme volatility. The VIX, Volatility Index, will spike. Oil will spike. Gold will spike. The dollar might even spike temporarily as a safe haven before resuming its long-term decline. But the only asset that holds no counterparty risk, the only asset that cannot be printed by a central bank or sanctioned by a government, is physical gold. We are witnessing history. January 3rd, 2026 will be remembered as a pivot point, the day the energy war went hot. It is imperative to be on the right side of this trade. It is imperative to hold real assets. And it is imperative to understand the psychology of the market makers who use news as a weapon against the uninformed. This analysis aims to provide clarity in a confusing time. The question remains, will oil hit $100 this month? Will China retaliate? The engagement of the audience helps to spread this truth. Like, subscribe and share to break through the algorithm. Pray for peace, but prepare for the storm. Peace be upon you.